Hi folks, in this video I'm going to show you 10 transactions that are hidden inside QuickBooks Online. Well, technically they're not hidden, they are basically created without your consent. And they're automatically generated when a specific event or trigger happens. And hey, I'm an accountant, I don't want any transactions to happen without consent. Anyway, this is going to be sort of an advanced video, so if you're brand new to the world of QuickBooks, a lot of these things are going to go over your head, and I understand. However, if you do watch it and you're a brand new user, you might learn a couple things about the mechanics of how QuickBooks behaves and how it was programmed in the beginning in order to adhere to accounting rules. At the end of the day, these hidden transactions per se that we're going to discuss are actually, they're generated for the very purpose of balancing the accounts, of creating that balanced debit and credit. We're going to go through them and you're going to see exactly what I mean. So we'll group this into 3 categories. We're going to deal with opening balances as one group, then adjusting balances as a second group, and the last one would be the retained earnings transfer from net income to retained earnings at the end of the year, and I can explain the mechanics of that. Let's start with beginning balances. So we're going to do a new account first. We're going to create a brand new account, and we're going to see what happens when you create a brand new account with a balance. Now I have a brand new, fresh QuickBooks Online file. I got a balance sheet here that shows 0 numbers and a profit and loss here that shows 0 numbers. So you can see that we're starting from scratch and you can kind of understand the mechanics of what's happening in our financial statements while these transactions, these hidden transactions, are being created in our behalf. So the first thing I'll do is I'm going to create a brand new account in the chart of accounts. So I'm going to click on the accounting tab on the left-hand side, and then I'm going to click on chart of accounts. And that's the place that you go to create an account or edit existing accounts. I'll click on see your chart of accounts, and then I'm going to create a brand new account. So I'm going to click here on new on the top right, and then I'm going to select account type. I'm going to pick any of the accounts that are balance sheet accounts. So that's everything from accounts receivable being the first one in the list all the way down to equity, which is the last one on the list. Anything below equity like income, other income, cost of goods sold, expenses, and other expenses, those are profit and loss accounts. Those don't count. This issue doesn't happen to any of them because we cannot enter a beginning balance to any of them. So if I select income, other income, expense, whatever, I don't have a box here that says, hey, what's the beginning balance? However, if I create a balance sheet account, let's say, for example, a fixed asset account, I'm going to create, let's say, an asset that I have, which is a truck. So I'm going to go to detail type. I'm going to go down and find the one that makes the most sense. So I'm going to select vehicle here. And then under name, I'll just put here Toyota 2020 Tundra or whatever, right? So I'm basically recording the assets that I own as a business. And I'm going to put in there my original cost. And this is what most users do. If they don't know exactly what they're doing, they'll just try to put random things in here and they're really going to mess up with their balance sheet. But anyway, there's nothing wrong with using this. You just need to understand what is the hidden transaction that happens when you create a new asset with an opening balance. So let's say, for example, the truck cost me $32,500, and as of, let's say that's the day that we bought it. So let's say we bought it on August 31st, 2019, right? So I'm creating a new asset account or a new balance sheet account, and I'm entering a beginning balance. I'll go ahead and click on save and close. And without your consent, a transaction was created. You can't tell because QuickBooks didn't show you the transaction or warn you, but you just have to know that this happened. And the way I can prove it to you is I'm going to go to the balance sheet, and then I'm going to click on run report to refresh the report. And now you see that a balancing transaction was created. A Toyota Tundra debit was created for $32,500, and an opening balance equity credit was created for $32,500. If I click on the magnifying glass on the top right where it says search, and I click on the drop down menu, I'm going to get a list of all the recent transactions. I'm going to click on that very last recent transaction, which is the only one I have in the books, and we can see the actual journal entry that was created. This is what QuickBooks does. It'll create this journal entry to enter that beginning balance. Now, at this point, should you do something with this? Well, this is where the accountant really comes into play. Generally speaking, if you're going to be entering all your opening balances, this opening balance equity should really be retained earnings. And there's a long-winded accounting explanation as to why that's it. But that should be retained earnings because technically you shouldn't have anything in the opening balance equity account. As a matter of fact, having something in your balance sheet in that opening balance equity account with a balance is a clear indication that something was created in your behalf, or in some cases, users will put stuff into that opening balance equity account, but for the most part, it's QuickBooks pushing that in. So that's the first one, which is creating a new account. Now let's do a bank connection. So what if I were to connect a bank to QuickBooks? QuickBooks actually is going to push and create a beginning balance on that bank feed, which actually confuses most of the users. So let me show you how that works. So I'm going to go into where it says banking, and then I'm going to click on banking. Then I'm going to click on connect account. Then I'm going to choose the bank and enter my username and password. After I enter my username and password for my American Express, I'll click on login and do my standard connection process of connecting the credit card. And this is key here. Once you connect a bank account, a credit card, or a loan into QuickBooks, you're going to map that into something in your chart of accounts. So I'm going to map this into a brand new account I'm creating. That's a credit card account. It's going to ask you the magic question, which is, we will pull the transactions from the selected accounts from X date, right? So whatever date I pick here, pay attention, whatever date I pick here, QuickBooks is actually going to read from the bank what was the beginning balance on that day, and it's going to bring that as an adjusting entry. So let's say that for whatever reason, I only want to bring starting September 1st. And I'm going to go ahead and click on connect. And then once it's finishing connecting, QuickBooks will put that beginning balance as of November 1st in order for it to make sense for the user so they can reconcile the account moving forward, and the balance in QuickBooks matches the balance in your bank or your credit card. The problem with this is it creates a hidden transaction. It creates a hidden entry. So let me show you. I'm going to go back into the balance sheet. And if you notice, the only transaction I had there was the Toyota Tundra. I'm going to go ahead and click on Run Report. And now you're going to see a new account created. Let me go ahead and select all dates here in the balance sheet and click on Run Report. And you're going to see a new account created called Amazon Prime Business Card, which has a balance. And that's the beginning balance on November 1st, which is the day that I picked for you to go back to when downloading the transactions. So notice that there's an opening balance equity transaction equal to the Amazon opening balance credit card that I connected. Now, why is this one a negative and the other one was a positive? Well, this is because the credit card is a liability. You owe that money. So that basically brings your equity negative, not positive, which is the opposite of the truck, which is a fixed asset, is an asset, not a liability. So I'm going to click on the magnifying glass menu again where it says search, and then I'm going to click on this transaction called credit card expense. Now, what's different about this one is that it didn't do it as a journal entry. It did it as a credit card expense. So the way it works is if you enter a beginning balance of a bank, for example, this will create it as a deposit. If the beginning balance of the bank is negative, you'll create it as an expense. In this case, the credit card had a positive liability, which is an expense. And then if your credit card balance was negative, so they owed you money, this will go as a credit card credit. So there's basically a natural transaction in the workflow of QuickBooks that's supposed to match the account that is being connected. So just be aware that every single time the bank is connected, either credit card or bank, that is going to happen. So again, what should we do? Should we leave it in opening balance equity? Like I said, that this is where the accountant will come into play and make this decision. But generally, this should go into retained earnings. Now, the challenge is we put everything into retained earnings if we're dealing with last year and we already done a tax return and we're not really too worried about what's going on this year. So if you do something that goes into retained earnings this year, you're going to create major problems in your accounting. Again, that's where the accountant comes into play and needs to make a decision as of what that 350 opening liability balance means and where it should go. But generally speaking, again, if you're doing last year and tax returns already done and you're not going to use QuickBooks to refer to for last year's, only for the current year, then the right entry would probably be retained earnings. Again, consult with your accountant to figure that out. I'm just trying to show you the hidden transactions. I'm not trying to show you generally what the actual accounting entry should be. Anyway, so that was creating a new account in the chart of accounts and doing the bank feed connection. Let's talk about creating a new customer with a beginning balance. What happens when you do that? So I'm going to go into QuickBooks here, and then I'm going to go into sales, and I'm going to go into customers. And then I'm going to go to add customer manually, and I'm going to create a new customer. So let's say I got a customer called XXS Corporation, and I'll skip all the details. And then down here somewhere, it's going to ask me for a beginning balance. That's going to be here, notes, tax info, payment and billing, right here. On the payment and billing, there's a box that says beginning balance. So if the QuickBooks user gets to this box, and I know a lot of people don't even know how to get there, but if they do get into this box and they say, yeah, for sure, this customer owes me $20,000, and therefore I should enter their opening balance. Okay, sure. So we'll put here $20,000. Notice it's asking you as of date. This is the day I'm recording the video. So it defaults to today's date. You can go back and push this back to the beginning of the year if you're entering the beginning balance of that beginning of the year. But let's say this is the beginning balance today, the day that you're setting up your QuickBooks. So we'll go ahead and click on save. And what just happened here is a hidden transaction was created. It didn't ask me about it. It just did it. Notice that an invoice, it's being created. So what happens? Let me go into my balance sheet, and then I'm going to click on all dates here, and then click on run report and see what was created. Look, accounts receivable was created for $20,000. But when I scroll down, I see net income for $20,000. I don't see opening balance equity for $20,000. So that's actually different, right? So when you create a customer with a new beginning balance, it doesn't do it with opening balance equity like the other transactions do it. What happens is I'm going to click on the search menu or in the transaction history menu and click on that. And this is basically an invoice that was created. Now, QuickBooks picked the product or service to use for this invoice. It just picked the generic sales item that's created by default, and it posted it into that, and that went straight into income. Now, I could change the item here and post this to something else. Let's say, for example, I wanted to choose a different income category, not my generic income category. I could do that by creating the item and mapping the item. That's a subject for an entirely different video. I'm focused on this transaction that was created sort of without your consent. So at this point, I wouldn't change it. I wouldn't change this to opening balance equity or retained earnings in any way. I actually like the way this is set up. You can change the description if you want to be a bit more explicit, but that's basically what happened. Now I'm going to go into the profit and loss report and click on run report. And let me do here all dates and click on run report. And you see that sales is being posted for 20,000. That's the same 20,000 that's transferring over to the balance sheet. I already closed it, but to the balance sheet's net income. So that's really important. Now, if I click on accrual method or accounting method, and I switch that from accrual to cash, and I click on run report, then that's not going to show up in there because this is an opening balance and my customer hasn't paid me yet. And that's basically the difference between a cash and accrual. Again, a subject for a different video, but it's just giving you an idea more or less how this thing is posting. So QuickBooks created an invoice in your behalf when you created a new customer with a balance. If you create a customer without a balance, no hidden transaction will be created. Now let's do a new vendor with a balance and see what happens. So I'm going to switch over to expenses and vendors. I'm going to go into the vendor section, and then I'm going to go into add vendor manually, and I'm going to create a new vendor. So let's say we have YYY supplier, and we're going to scroll down and go to opening balance. Notice that I don't have the little tabs like I had with the customer. This was actually right there for your viewing. So let's say, for example, this vendor, we owed them when we created the vendor, we owed them, let's say, $9,000. So I'll put that in there. Again, I'll leave the date as of 9/20, or I'm welcome to change the date. Let's just change the date for the heck of it. Let's say that's as of the 17th of September. So I'm going to go ahead and click on save. And again, a transaction was created in my behalf without me even knowing it. I'm going to click on the vendor here and then see the bill that was created. I'm going to click on that bill, and then notice that the vendor is created and there's actually no category in here, because the way QuickBooks does it, it sort of creates a hidden category behind the scenes. So I can change the category if I want to, but I'm not going to change it yet. So I'm going to just click on save for a second. Just leave this transaction open. Let me go back into the profit and loss and click on run report and see what happened. And basically, QuickBooks generates this transaction called other miscellaneous expense. This is how it does it, right? So I'm going to click on that 9,000, look at the detail, click on the bill, go back to the bill that we were looking at, and there it is. So basically, QuickBooks finishes entering the other miscellaneous category in there. The first time you opened it, you didn't see it, but once you kind of confirm it and go back to it, you will see it now. So I can change this. So if this is not other miscellaneous expenses, if this is job supplies, whatever, I can change it. I have total control over that. But that's kind of the point. Let me close that and go back into the profit and loss again so we can see the effects of that. Click on run report. So now this stuff is going into job supplies. So again, I created a new invoice. It went straight to an item called sales, which pointed into the generic sales income category. The vendor with a new balance went into other miscellaneous expense. And this is without your control. You would have to know that this happened. You would have to detect it in the profit and loss on the balance sheet, and you would have to go back into the transaction and change it if you want to fix it. Let's do the last one of the new opening balances, which is new item entry with beginning quantity. So at this point, I think you kind of get the pattern, right? You're creating new things with opening balances. QuickBooks has to plug it in somewhere, and this is essentially what's happening. I'm going to click on the sales tab and then go down to products and services. And then I'm going to create a new product and service that's an inventory part. Now, inventory is disabled for a second, so I'm going to go ahead and turn it on. Because this process will only work if it's an inventory part. Non-inventory service, you can do beginning balances for them anyway. So I'm going to click on inventory, and let's say I'm going to create an inventory part. So let's say I have my widget 1, and I decided to say, yeah, I got like 17 of them in stock, right? And as of date, we'll just put, let's say put yesterday's date on it, the 19th. And reorder point doesn't matter if I put something there or not. And then under price, let's say we sell these widgets for $25. And then under cost, let's say we pay $12.50, right? So we created the new item, we put it in the database, we put an initial quantity on hand, we put the date, and we put the cost. I'm gonna go ahead and click on save and close. Again, QuickBooks didn't warn me, it created a transaction for me. So I'm going to click on the search button or the transaction history button, and then click here where it says inventory starting value. I'll click on that, and then I get to see the underlying transaction that's being entered. So basically $212 worth of value is being sent into my opening balance equity account in order for QuickBooks to book that beginning balance of $17. I'm going to click on save and close, and then I'm going to go back in the balance sheet and kind of see what that looks like in the balance sheet. So let me open up the balance sheet. Let me do all dates here, and then click on run report. And then we're going to notice that we have an inventory asset of $212.50. We're going to scroll down, and there it is, opening balance equity, the dreaded opening balance equity showing me a balance there. Again, if I wanted to change that, I would click on that, click on the transaction itself, and change that to whatever the correct account it is, depending on the circumstance. This is where you get your accountant involved. This might be cost of goods sold, right? If it's a mid-year inventory adjustment, or this might be retained earnings if I'm entering last year's opening balance. So again, this is why QuickBooks doesn't guess for you. It just puts it into opening balance equity, which is basically a big red flag for the accountant to make sure that they look at that account and see everything that was created in there and fix one by one. So I'll go ahead and click on save and close. And that's the hidden transaction when you create a new inventory item. Let's move over to the adjusting balances. This got a little bit tricky. And as suspected, when we created a new account or customer or vendor or item with a beginning balance, it entered that beginning balance adjustment. Now, if I were to delete it, the same thing, the account, the customer, the vendor, or the item, if I were to delete them and they have a balance, then QuickBooks will then enter an adjustment to get rid of them. So let's see what that looks like. Let's go back into QuickBooks here, and let's go back into sales, and let's do a new invoice first. Let's do something so we don't touch the existing transaction that's there. Let's do a new invoice here, and I'm gonna pick that same customer, and I'm gonna go back, let's say a couple of days, and I'll pick an item here at random, or we'll sell a widget. I guess that would make sense, and we'll sell a widget. Let's say 5 widgets, and let's put today's date. That'll be easier. And then we click on save or save and close. Either one will work. And there's a sale made. So now when I go into sales and I go into customers, I see how much money my customer owes me, which is the original $20,000 from the beginning balance and the $125 from the current balance. So now my customer officially owes me $20,125. When I go into my balance sheet, let me go into my balance sheet here and do all dates. I should see that my accounts receivable matches that $20,125. So what happens if I were to go into QuickBooks and delete that customer? Let's see what that looks like. So I'm going to go into sales and click on customers. And then I'm looking at the customer. It has a balance and I'm ignoring that I shouldn't do this, but I'm going to do it anyway. I'm going to click on this drop-down menu here. And actually, deleting customers is a little bit different. I'm going to click on the customer and then I'm going to go to edit. Okay, I'm going to go to edit and then I'm going to go down and click on make inactive. So I'm going to make the customer inactive. I'll click on that. It says it has a non-zero balance. Making this will make an adjusting entry. Is that okay? So this is probably not as hidden as the other ones because I'm actually getting a warning on this one, which is interesting. QuickBooks decided to do warnings on these, but not warnings on the opening balances. So that's pretty cool that they did that. So I'm going to click yes and approve that. So you got me there. It wasn't a hidden entry, but it did kind of happen without me looking at the transaction in itself. So I'm going to go back into my balance sheet and click on run report. And then I'm going to see that my accounts receivable is now 0. And what's really interesting about this is the way it's zeroed out is by creating something called a credit memo. So I'm going to click on the search menu here, and then I'm going to click on the credit memo that was created so we can see exactly what's going on. And as you can tell, QuickBooks created a credit memo for the $20,125. It put a note saying, hey, I did this, right, which is good. And it used a generic account called sales, which is the same generic account that QuickBooks would have, or item, sorry, that QuickBooks would have used if it would create an invoice for you with a beginning balance. So that's the adjustment of the accounts receivable or of customer's balance if you were to delete it. Let's see what happens with my accounts payable. So I got a vendor here with a $9,000 bill or $9,000 accounts payable. What if I were to go into expenses and vendors and where to delete this vendor? This one is not here in this drop down. It's kind of the same process. We click on the vendor itself, we go into edit, and then we click on make inactive. We get the same warning, which is perfect. We click on yes, and then a vendor credit is created. A vendor credit is kind of the brother or the sister of the credit memo, doing the same thing, reversing the accounts payable. So let me refresh this report and see how my accounts payable is now 0, and then click on the search box to see my recent transactions, open up that vendor credit and see what happened. QuickBooks automatically generated the vendor credit. Notice this time it picked, or it continued to pick, the other miscellaneous expense category, even though I had changed it to job supplies. At this point, I would have to decide what category I would like to do for this. Now, I'm not going to change it to show you what kind of weird consequences this could have. I'm going to go and pull up a profit and loss so you can see. So here's a profit and loss. Let me do all dates and click on run report. And notice that this is what happened, right? The first initial balance we created to job supplies, which gives me a positive job supplies expense. But now, if you look at other miscellaneous expenses, that shows up as a negative. That just looks weird. Again, I'm reversing the original transaction, but technically this adjustment should go to the same original category that the bill was entered in. So it requires for you to do a little bit of research before you just willy-nilly delete customers or delete vendors. Okay, so let's talk about deleting the inventory item that has a balance. So let's go back in here. We're going to go into sales and then products and services. And we have an item here called widget 1 that has a quantity on hand of 12. So I'm going to go back into the balance sheet real quick just so we can see what that represents. I'm going to go into the balance sheet here and then click on all dates. And then we see right here, inventory asset 150. So that's what I'm going to reverse right now, whatever my opening balance of my inventory is. So I'm going to click on the drop-down menu. This one is added to the drop-down menu on the right. And then I'm going to click on make inactive. It says, are you sure you want to make it inactive? Yes. This time I didn't get the warning that there's opening balance there. So this time it didn't warn me. When I click on the recent transactions button, there's an inventory quantity adjustment. When I click on that, I'm looking at the adjustment firsthand. There's the item here that shows that it was deleted. No problem. And then notice that the inventory adjustment account is inventory shrinkage. Now, I don't know why it picked that. Sometimes you'll pick cost of goods sold. Maybe you'll pick opening balance equity. Either way, you probably need to pick the correct category. And that's where your accountant comes into play. But cost of goods sold, inventory shrinkage, any of these is probably the correct account anyway, because you're making an adjustment in the middle of the year. So we'll click on save and close. And that's the hidden transaction per se that's created when we do that. The next one is a reconciliation discrepancy. This is when you try to reconcile the bank account with the wrong balance and you force it to match. So let me show you what that looks like. I'm going to go back here into banking, and I'm going to finish categorizing these transactions that came in through my American Express Amazon credit card account. For the sake of it, I'm just going to select them all, accept them as is, and just move on. So then it's time for me to reconcile the credit card. Let's say that the ending balance on my credit card is $600 on the dot. I'm looking at the bank statement in front of me, or the credit card statement rather, and I'm looking at the ending balance and it says it's 600. So I'm going to go do my reconciliation, and I have other videos that explain this a little bit slower in detail. But let's say I'm going to come in here and I'm going to select my credit card, my Amazon American Express, and reconcile that to 600. And let's say that was on November 30th, 2020. Okay, so I got my statement in front of me, the ending balance I entered in there. I click on start reconciling. I went in there and I checked that every single transaction is in the statement. I matched it with QuickBooks, and for whatever reason, I can't get it to match exact. And I'm tired of it. I did everything I needed to do, and I'm saying, you know what? I'm just gonna screw it. I'm just gonna force the reconciliation. So QuickBooks allows you to do that by clicking on the drop-down menu where it says Save for Later, and then click on Finish Now. So because you're supposed to get to 0 before you reconcile. And again, if you want to know how to reconcile, I'll put a link to that below. So I click on the drop-down menu and then click on Finish Now. So again, it does take a little bit of creativeness to click around to get there. And then you get this pop-up that says, hold on, this is not the difference of 0. However, we'll let you push through by choosing the adjustment date and then clicking on Add Adjustment and Finish. So technically, it's not a hidden transaction, but again, it might be hidden for the most people that don't understand what's happening. So we'll click on Add Adjustment and Finish, and woof, we were able to reconcile. We did away with the nightmare of trying to find those $84. But what happened? Again, I'm going to go into my balance sheet, click on Run Report, and then select all dates. And my credit card is now $600 the way it's supposed to be. So that's perfect. No issues there. But if I were to run a profit and loss, this is where the reconciliation discrepancy comes into play. I'm going to click on Profit and Loss, and then click on All Dates, and then click on Run. And then you will notice that there's a transaction here called Reconciliation Discrepancy under Other Expenses for $84.47. Now let's see what that looks like. I'm going to go ahead and open it. And in this case, it was a credit card expense. So if the adjustment is a difference between what's in QuickBooks and a higher amount, this will do a credit card expense. And if the adjustment would have been going down, it would have been a different transaction. Let's do it anyway so you can see exactly what that looks like. So let's say I say, whoops, it wasn't 600, it was supposed to be 500. So we'll go back here and click on Reconcile and do the credit card again, and then put 500 and put 09/30/2020. Again, we're doing this all wrong. I'm literally showing you how to do this all wrong, but I'm illustrating all the things that happen when you do the things wrong. So I'm going to go ahead and click on the drop-down menu and click on Finish Now, because again, I'm trying to force this down to 500. Click on Add Adjustment and Finish. Okay, click on Done. I can now go back into my balance sheet. Let me pull up my balance sheet here. Balance sheet, and then go to All Dates and click on Run Report. And my credit card is at 500 because I force reconciled it into 500. But now when I pull up my profit and loss, let's bring that profit and loss in here. You're going to notice what happens. And let's do All Dates. Now notice that my reconciliation discrepancy is a net negative number. When I click on that, we're going to see exactly what it is. It's a $100 adjustment and an $84.47 adjustment, and the $100, which was in this case positive. We had a credit to our favor in our credit card, so we owe them less money. That's when we went from 600 to 500. The transaction here is a credit card credit. So the credit card credit is the one that's used to reduce the balance of a credit card, and the expense or the credit card expense, let me click on that one. The expense or the credit card expense is the one used to increase the balance. So these are two forced transactions that were entered because we told QuickBooks that we kind of wanted to force that balance in there, and then that net difference gets posted into reconciliation discrepancies. Woof, we covered a lot, quite some ground there. Opening balances and adjustment balances. So that should be pretty clear. The next one is necessarily not a hidden transaction, but I think it's really important to know what happens to my net income when the fiscal year ends. So for example, I'm going to go back into my profit and loss for all dates and see that my net income is negative 362.25. I'm going to go into my balance sheet again for all dates, click on run report, and then see that my net income is 362.25. Now that's because I'm showing all dates in this case. If I were to pick an actual date range, let's say I were to look at this the next year in 2021, I'm going to do 01/01/2021 through 12/31/2021. You will notice what happens when I click on run report. I will no longer have a net income number that's positive, and I'm going to have a number that's going to roll over to retained earnings. So how is that even possible? How did a number get rolled into retained earnings? Well, what happened was that every year at fiscal year end, that number rolls over from net income into retained earnings. However, if I were to run this report, let's say on December, so let's do of 2020. So let's do 12/01/2020 to 12/31/2020 and click on run report. My net income here that's accumulated for the whole year is a negative 362.25. That's the stuff that's accumulating for 2020, and it's not going to move into retained earnings until we cross that fiscal year. Now, currently my QuickBooks is set up for calendar year to be the same as fiscal year. So if I were to change my fiscal year, that number would have changed. Let me show you what that means. I'm going to click on the gear menu, click on account and settings, and then go into advanced. And then I'm going to change the fiscal year in this case to November. So let's say my year officially ends in November, and we're going to do the same thing here, same as fiscal year, and then click on save. So essentially what I'm doing here is I'm telling QuickBooks that my year ends in November. So if I were to pull this report, let's say for this, let's do this fiscal year, which ends in October, click on run report, right? I still see net income in there. But if I go up to, let's say, November 1st through the 30th, which is the next year, because we picked fiscal year, you don't see anything else in net income, and you see it moved into retained earnings. That's a really important point, that transfer of net income, which is not a transaction, it's just something that happens behind the scenes, happens at the cut of the fiscal year. Most people are January through December, but some people elect to do the specific date range. Anyway, I know this was an advanced video. I know this was a lot of moving parts, and I hope this was helpful. Let me know, is there other kind of weird hidden transactions that you see in your QuickBooks file? Did I miss something? Put that in the comments below, and remember to hit like, share with your friends and family, hit subscribe, and I'll see you on the next one.